Okay. Thank you, Ranjana. That was a very interesting session around the past, the present, and the future of Indian impact investing. And I'm fascinated to see how the journey of the last 20 years was so beautifully summarized by the veterans in this space, both from the LP as well as the GP side. We now move on to our next session on unlocking domestic capital into impact investing, the HNI family office perspective. As many of you may be aware, the Indian impact investing sector is predominantly funded by development investors, international particularly, and there's an active need for us to explore the optionalities of enhancing domestic sources of capital. In recent times, we've seen increased interest from family offices into early stage VC financing as well as impact investing. This session on the HNI family office perspective of unlocking domestic capital is being brought to you in partnership with Asha Impact, and we're thankful for their support. We have an illustrious panel, so let me quickly start with the introductions. We have with us Padma Shri Mr. Sanjeev Bikhchandani, the founder of Naukri.com, India's leading job site. Company also runs Jeevan Sathi, 99 Acre Shiksha, and in addition, his organization has made strategic investments in promising web startups such as Zomato, Policy Bazaar, Shop Kirana, Ustra, I can go on, Gramophone, and several others. While all of you know about Mr. Bikhchandani, but still he graduated from IIM Ahmedabad in 1989 and set up 1997. He set up Naukri.com. Starting off from very, very small beginnings, the company grew and attracted investments from leading venture capitalists to the first internet company to list on the Indian stock exchanges. And today the company employs over 4,000 people with a market cap of over USD 3 billion. Mr. Bikhchandani also with his partner Hitesh Oberoi won the Ernst & Young Entrepreneur of the Year award in 2008 for business transformation. So Mr. Bikhchandani for you. I'll now move on to Ms. Padmani Somani. Ms. Somani is a principal at the Narottam Saxena family office, set up from the family's divestment from Ambuja Cement. The family office has interest in diverse asset classes and is headquartered in Mumbai. Family office participates in businesses across various sectors, including technology, human capital, finance, financial intermediation, and retail. She has been active in the philanthropy and development space for over 20 years. She established Salam Bombay Foundation that she founded in 2002, working with more than 3 million children across India. She is recognized for her work in youth education, health, and skilling programs with vulnerable and marginalized populations. Having established the largest preventive school-based program in tobacco control in India, she has also received several awards and recognitions, including from the WHO and the Mayor's Citation from Michael Bloomberg. Padmani also heads the Narottam Saxena Foundation, a family philanthropy that is engaged in health, education, and livelihood programs with interventions in rural and urban areas focused on community health. She also serves in various boards of organizations, including the Prince Ali Khan Hospital, Ambuja Cement Foundation, Harvard T.H. School of Public Health, India Center, and the India Youth Fund in New York and Vassar College. Padmini has a BA in Economics from Sophia College, Mumbai, and MSc in Financial Economics from the University of London, UK. Mr. Vikram Gandhi is the founder of Asha Impact, an impact investing platform. He's a member of the faculty of Harvard Business School, where he teaches in both the MBA and executive education programs. He's a senior advisor to the Canadian Pension Plan Investment Board. So Asha Impact is a platform set up by socially conscious individuals led by Vikram, which leverages their combined capital networks and expertise to address the critical development challenges facing India and other emerging economies. Prior to his current position, Mr. Gandhi was Vice Chairman of Investment Banking and Global Head of the Financial Institutions Business for Credit Suisse, New York and Hong Kong. And prior to his tenure at CS, or Credit Suisse as it's commonly known, Mr. Gandhi also worked at Morgan Stanley, where he was co-head of Global FIG in New York. Mr. Gandhi holds an MBA from the Harvard Business School, where he was designated a Baker Scholar, and a BCom high distinction from the University of Mumbai. He's also a qualified chartered accountant. Unfortunately, as we had earlier said, Mr. Munjal, who was supposed to be with us, did not make it. But however, we are happy to inform you that he'll be joining us in a separate keynote on the 7th at 4:45 p.m. India time. More on that later. But over to you, Vikram, to take the session forward.
Thank you so much, Ramaraj. Thank you for those very kind introductions to all three of us. And it is indeed my deepest pleasure to be part of this panel and to welcome Sanjeev and Padmani to this panel. I've had a long history with the Impact Investors Council. In fact, I worked closely with Jayant Sinha when he was at Omidyar Network to actually set this council up with the key objective that India was one of the few markets outside the Western world where impact investing was really getting a lot of traction, and having an industry body of impact investing like the CII or FICCI or something like that would be critical to kind of advance the cause. And we were very, very fortunate that Ramraj joined us as the CEO recently to really take the organization to the next level. So I'm absolutely delighted to be part of this panel. One of the key things, and what the title of this panel is that how do we get more domestic capital focused on impact investing? I mean, even if you look at all the statistics, most of it, as Ramraj said, is international money. Even the domestic funds, still more recently, while they were domestic funds, most of the LPs were international, limited partners were international. So the question is, why do we not get more impact investors in India? But I think the one fundamental thing, which is one of the reasons why I actually set up Asha Impact originally, was that, and it's a network of family offices. Essentially, Padmini's family offices is part of that. We've made co-investments with InfoEdge on a bunch of different investments. Is that how do we actually get more domestic capital into this area? But first and foremost, I think, which I'd like to emphasize today just as a starting point, is that when we talk about impact investing, people sometimes forget about the investing part. It's about the impact. It's like, what impact am I having? What is the social aspects? What is this? But first and foremost, and this is a course that I developed along with another professor at the Harvard Business School, it's called Investing, Risk, Return, and Impact. Before any impact, it is investing. And therefore, and that's what's the difference between this and maybe philanthropy, is that it is investing, it's trying to create value, but it's trying to create value at the same time as having impact. And so therefore, I'd like to start this conversation with really a focus on that as to how, we think about investing, how is investing involved, and then how do we bring in the impact perspective on this? And I think that's important for our audience here, who are largely, a lot of them are LPs, a lot of them are family offices, but a lot of them also are social entrepreneurs, to understand that when someone is investing in your company, they're expecting you to have impact, which is fantastic, but they're also expecting you to generate financial return. So with that, let me start with you, Padmini. Thank you so much for being with us. You run one of the more successful family offices in India, very sophisticated, very thoughtful. And maybe I'll start with you as a family office. How do you think about portfolio allocation? How do you think about running a family office? What are the objectives, both let's start from a return, from an investing allocation and asset allocation perspective.
Thanks, Vikram, and thank you for having me here. So let me sort of start by giving you a little bit of a history of how this family office came to be. I think when we started our family office, when we divested from Omidyar Cement, I think the family office was possibly one of the first family offices in the country. So I remember my father telling me, when we were setting up a family office, I didn't even know the meaning of the word family office. And, we were literally going out and looking at best practices, and we went out and saw them from Europe and the United States and Australia, where there were multi-generational family offices set up. And we started thinking about what do we want our family office to look like. I think there were some defining principles which we've used to set up the office and to think about investing in the long run. I think the first thing is that we've realized that now going forward, we think about the family office wealth as something that we hold in trust, something that we are custodians of for many generations going forward. So the risk profile becomes quite different than when you're an entrepreneur and when you're actually thinking about, business. So the lens that life was when we were Ambuja was very different than what it is when we're a family office. So I think being risk averse is sort of the starting point of how family offices are. And I think your point about attracting capital for venture or social impact, one of the big, reasons why family office participations tend to be low is because they all tend to be this safe capital pool where, the risk profile has sort of defined what they will or will not do. And maybe, as we go along today, we'll bust some of those myths. But the fact of the matter is that is the starting point of how a family office really thinks about it. In terms of assets and returns, we actually do our investment across a wide range of assets and pretty much in every asset class. But I also feel that, again, given the risk profile of the family office, our tendency to be in venture capital stage companies tends to be less than 1%. And that's something which, even though we're saying, ideally we should be growing that number and becoming much larger than where we are today, the fact of the matter is, I think that, we have some way to go. Someday we want to be 10%, on venture capital, but that's not today. Today we're still looking at very conservative numbers and, playing that really from that perspective. So that's really how today we're looking at it. And from a risk return perspective, I think there's a huge desire in the family, and maybe it comes from the kind of person my father is. He's always believed more in terms of not about just generating returns, but backing the right entrepreneurs and the right businesses, and really learning as we go and do things. So there's a lot of bent on really looking at governance and values and delivering impact and all of that across everything we do. So not only whether it's venture capital, but even large scale investing that happens. So it is the cornerstone of our thinking, to be driven by the same values by which we've actually been able to come into this wealth. So that's really just the starting point of where we are.
Thank you, Padma. You raised two things which I'll come back to you on, which is this 1%, as well as this issue of thinking about impact in all your investments. And I'd like to dig into that a little deeper. But let me first bring Sanjeev into the conversation. Sanjeev, you had one of the most successful track records of investing, even though as InfoEdge, you were not meant to be an investor, you're more an operating company. I think the audience would love to hear a little bit about your journey as to where you were and how you've got to where you are, as you're in the process of setting up a fund right now. But more equally from an InfoEdge perspective, but also from a venture capital perspective in India, because most impact investing globally is kind of venture capital. We Series A, Series B, maybe even some seed investing. And venture capital in India is, again, we talk about impact investing having very little domestic capital. Even venture capital has very, very little domestic capital in the context of the overall capital availability. So over to you, Sanjeev. Would love to get your perspective on that.
Thank you. So look, we sort of ventured into investing by kind of accident. So we had listed the company in 2006, and we had this little bit of money sloshing around. And one of the objects of the IPO, which was that we will use it for acquisitions and inorganic growth, the money. And then when we did post the IPO, we looked around and we figured there's nothing available at any kind of price that we want to buy it at. So on the other hand, there are a whole bunch of young entrepreneurs who are trying to do stuff, and someone is looking useful and potentially good. And why don't we back them? And then over time, if the company succeeds, we'll invest more and more and figure out and then see what happens. So it began as a small sort of cottage industry inside the company. I was doing it with a little bit of my time, investing in one company, two companies, three companies, and so on. And then it grew. And now it's become a sort of full-blown activity. We are setting up a fund. But you see, our primary objective was not impact. Our primary objective was good, sound, solid, well-run, well-governed, honest businesses that make a difference. Right? In the process, we will create value for our shareholders. Right? But the fact, now in hindsight, the fact also is that in order to create value in India, right, you have to scale. Right? In order to scale, you will have to deploy capital and give a return on the capital, because you can't scale on dole. You can do a pilot on dole, on CSR, you can do a pilot. But really to make impact, and now Zomato, for example, pre-COVID employed 2.5 lakh riders. It created so many livelihoods. Now, was it the primary goal? Answer is no. It ended up making impact because it scaled. Policy Bazaar employs 10,000 people, right? It's delivering fabulous returns to its investors. It's making an impact. It is ensuring, propagating insurance in an underinsured country. There's a company we invested in called Shop Kirana. Shop Kirana, is counterintuitive. It is saying that, look, in an era where you have organized retail, large retail, and an era where we have e-commerce, we believe the small neighborhood, Kirana store can succeed. And they're doing last mile delivery of grocery on same day, next day basis to the small shop, Kirana stores. Gramophone, where we've co-invested, right? We've invested in a company called MedCords. Which is rural healthcare. We invested in a company called, again with you, Adda 24/7, right? Now, these are all companies which, if they succeed, will create impact, or the kind of impact that impact investors look for. But that is not our primary goal. And they will not create impact if they do not scale. And they cannot scale if they don't make a profit. So fundamentally, we look at it from the prism of profitability, from the prism of return on investment, potentially, from the prism of solving an unsolved problem. And yes, in India, you can't scale if you don't go mass. You can't go mass if you're expensive. And to go mass, you necessarily have to go down the income strata. As simple as that.
Yeah, absolutely. But Sanjeev, tell me why is so let's keep the impact piece and I'll come back to you because this whole issue of impact really is like, yes, they have impact. A lot of people say, well, I invest in this company, it creates jobs, so it has impact, as opposed to the intent to not just, intent to create impact at the point of investing, but then also monitoring it over a period of time. But I'll come back to that in a second. But let's talk, I know we're talking about impact investing, which is a subset of that, but let's talk about the bigger picture. Is that why is still predominantly venture capital coming from global sources as opposed to Indian sources?
So look, several reasons, some of which are regulatory. I think you mentioned Jayant Sinha. He's heading a committee which has submitted a report to Parliament. I think if some of those recommendations are adopted, it'll help a lot. I think you got to understand that, look, venture capital is high risk, it's early stage. Second, it's long lock-in, long gestation period. Right? And actually, it's much longer in India in terms of lock-in and gestation period than it is in the West. Right? So if you look at most VC funds, they're architected to be 8+2, 9+1, 7+2 years. But if you look at exits for VC funds in India, it's very hard. And the reason why it's hard is strategic sales, if you leave out Flipkart, have not given a lot of value, the kind of returns that VCs look for. Which company buybacks are not viable, at least not enough to give value, the kind of returns that VCs look for. Then you're down to IPOs. Right? Now, IPO India, from seed to IPO is a 10 to 15-year process if you're good and lucky. We were lucky. We were really fast. We were 6 years from Series A to IPO, 9 years from inception to IPO. Make My Trip was 10 years from Series A to IPO. You look at India Mart, probably 18, 20 years. You look at Just Dial, maybe 18, 20 years. You look at Matrimony, 18, 20 years. So actually you need 12, 15-year money to do successful VC investing in India. Now, I do not know how many people in India will have those kind of time horizons. But look, it's like this. If there are success stories, others follow. Now, while we were in the waiting room, we will recall I gave you the anecdote of Zomato.
Yeah, why don't you show us that slide if you still can share it?
Yeah, one second. Let me just show the slide if I can. Yep. Now how do I share it? 1 second, yeah. Yeah, I got to share my screen. Boy, where's it gone? Here it is. Sorry, there's something wrong with my...
Okay, don't worry about it. Why don't you give us the facts then? Whatever the slides.
No, 1 second. I got to move this thing out of the way and now I can share it. Oh shit, what's happened? Sorry. Pardon my French. Pardon my French. I should not have said that. Okay, so this is a company...
chat, it's all good.
Yeah. I'm sorry, I'm supposed to be a tech entrepreneur, but tech defeats me very often. So this is what I believe that, look, if you look at our seed round, it has given us over 350x, but it has taken 10 years. We have not yet exited. And every subsequent round has given us lower X at a lower risk. Yeah. Right? But if you're good at spotting young companies and you go in early, you can get some great returns, but it has taken 10 years and we still haven't exited. Right? So that's the point I wanted to make, that look, it does make sense, but you have to have a very, very patient capital.
Understand. So you're saying that that foreign investors have a longer time horizon than Indian investors, or you think Indian investors are just not educated, or there's a regulatory hurdles or whatever?
There's many things. So look, until you have huge successes coming out of Indian capital earning fabulous returns from venture capital, you will not create a role model which others will follow. It's a matter of time. Now, the government of India set up this fund of funds for startups, and they've set 10,000 crores, and it was being run by SIDBI, still is. And I was in the committee for the first 2-3 years, and I saw firsthand, so you start a fund, so SIDBI says we'll put 15% of the fund, then you go and get the money from elsewhere, then you close the fund, then you begin to invest. Then after 7, 8, 10 years, you get exits. It'll go through its cycle. It took 40 or 50 years. You established the IITs in the 60s, right? It took 30, 40 years for the IIT alumni to really make a huge difference.
Yeah.
Until there were enough of them, then they weren't able to make that kind of impact.
Yeah.
Right?
Okay.
So these things take time.
Yeah.
So it'll happen, but you need success stories.
So Padmini,
you also need a favorable regulatory environment.
Yeah, which you're saying that they've, in terms of basically the institutional investors being allowed to invest. But let's stick with the family office for a second, Padmini. You mentioned that only 1% of your assets of your family offices in venture capital, but you'd like to get it to a higher percentage. So would you agree with what Sanjeev said, that it's just the time horizon issues? Is it the regulatory issues? Why is your portfolio on 1% venture capital, and how do you plan to take it to a higher number?
I definitely think that both those points that Sanjeev mentioned are true. But I think there are a couple of others which I also want to table. I think one of the things is that I feel that very often also venture capital visibility is lower in family offices. I think these deals tend to go to HNIs as individuals more than family offices. It's just become the nature of how the venture capital world has been functioning, that there'll be literally like individuals who sponsor the early rounds and then come into a more organization, sort of an institutional style round, which comes in later. So I think visibility is very low for us, very often in early stage deals. I also do think that there is a bit of that sort of mentality which still is there, or concern. Let's say that's not mentality. It's a bit of a concern that's there that we shouldn't do a investment philosophy which is so very spray and pray all the time. Like, that is in technology became really popular. Like at one point, IoT became popular. People wanted to invest in 15, 20 IoT companies, and then one or two of them might reach something worth remembering. The others, many of them just die a natural death. So I think that sort of thought process always holds us back, right? From just, again, the way the profile of the company is. The point that Sanjeev made about the time horizon, I just want to amplify that to say that I think there is a lot of struggle. And I'm really, really saying this out of complete respect for every entrepreneur who's put themselves out there to create a company or try to create a company. A very big struggle between seed or starting and becoming of scale. And I don't think it's obvious that just because you do the right thing and you're in the right place at the right time, always it happens, because India really is a difficult country to do well in. And it's unfortunate, but I don't think it's easy. It's not easy to be able to execute even the best of ideas and the best of people. We've seen them struggle for various reasons. Sometimes just really the ecosystem hasn't supported the business to survive. And the other thing which is really necessitated for companies to survive that long gestation is a continuous flow of capital. So I've also seen cases where when entrepreneurs are capable of drawing capital easily, like building confidence and getting investors in, they do much better. But every person wanting to start off may not have that ability, skill set, and also a group of well-meaning people are not always necessarily the right ones to draw those continuous rounds of capital burn that are required to make the 15-20-year journey. So there are many of these concerns, I think, which plague our decision making when we try to go in and really look at how and sometimes just simply, there are times when we've looked at companies where we really like the company, we like the business, we like the person, but we still can't understand how will they ever exit, how will they ever IPO, how will this company ever be able to do that level of, will it catch the fancy of so many investors in their journey? So I think these are all just, as I said, concerns, right? I'm adding to that layer of concerns that you've already put on the table.
So, as Sanjeev said, I think your family office has the same perspective, which is that, look, this is about investing, we're about financial returns, scalability, and kind of impact happens. That's a good thing, but that's not what's driving it. So talk to us about your journey in financial inclusion. I think basically, if you look at the sectors where impact investing, has had the highest volume, it's by far in financial services. So, and I know you've invested in a couple of small finance banks, maybe on microfinance before that. We've also invested in kind of, school lending companies, various other NBFCs. So take us through how you've been looking at those investments and how do you think both the financial aspects as well as the impact aspects?
So, interestingly for us, we've never really looked at them as separate. For us as a family office, because of our philosophy, I think we started by assuming that the business will have impact, but it has to financially give you returns and sustain itself. And I sometimes also think that, the whole social impact phrasing itself has been a disservice to the sector, because I know somewhere people have confused it to start saying that if it's social impact, it means it's impact, but that doesn't necessarily mean it has returns. I think somewhere we need to go and redefine the way we look at, or reframe the way we look at social impact.
You should just know that as a separate, I'm sorry to interrupt, but for example, I know a lot of funds in the US who are very impact oriented, or family offices, that have actually taken out impact from their name just because of that. Because as soon as you say impact, it's like subsidized returns. Yeah, and that still mindset is still so prevalent, even though 70 to 80% of so-called impact investing is very much market rate return kind of investing. Sorry.
Yeah. So just something building on from there, I'm saying that therefore I think that it isn't a trade-off to say either or, it's both. Start by saying the business needs to have impact, but it has to sustain itself. It needs to generate returns, and it needs to see that whole sort of life of, see to whatever stage you want to see it go. So I think that's definitely something that's across the board. I think for financial inclusion, just in general, in India, I think we've had a lot of success across all investors. I think because it was one of the early areas in which social impact got demonstrated, because in financial inclusion piece, given how behind India was when we started on this journey with microfinance and the whole joint lending, liability groups and all of those kind of ideas, I think, we were really, we were really in that sort of sharp learning that happened in India, and a great amount of returns that people saw. And then we had, again, structurally, government came in with policies which really, created a lot of headwind for the whole microfinance sector. So many companies suffered because of that. But then again, there was some positivity when they allowed them to convert to, small finance banks, and we started seeing that some of the stronger microfinance players were really able to play to their strengths and convert to banks and build both the asset and the liability side in the process of doing that. So I think it's been a very interesting journey to see that, and I feel for India, financial inclusion is still not a done thing. It's still a lot of stuff happening. We saw with demonetization, for example, such an immediate uptake in technology and in terms of digitization, and the whole financial inclusion piece getting a fillip, sort of in a different way because of that. But now with COVID, it's even more, right? Again, people are trying to do more online transactions. They're not even, there's no physical cash as much handling as one would have expected, in normal times. So I think a lot of those changes are still happening. The journey is still on. But that's also happening across the board in other sectors. We're seeing it not only in financial inclusion, but now, you see in digital learning, the whole learning environment is changing. So that healthcare is changing so much. Last mile delivery in healthcare has gotten impacted with COVID. It's become a big discussion point. Agri, energy, their livelihoods, all the areas.
Exactly. So we start with financial services, but one of the big, obviously there's huge negatives of COVID, but the acceleration towards digitalization as a result of COVID has really kind of created some very interesting models in healthcare, education, agri, etc. And Sanjeev, you've been right at the middle of this. So before I get to the impact piece, I just love to hear your thoughts as to where do you see the trends in ed tech, health tech, agri tech? Like how do you see that those areas evolving given what we are going through?
So look, it's a mixed bag, and we've got about 20-25 investments and our own internal businesses. And COVID and the lockdown impacted each one slightly differently, right? And the bounce back has also been slightly different in all of these. So in Naukri, we had in quarter one, we had a 44% decline in billing YOY. Billing, not revenue, billing. The bills we raised that quarter. Revenue is recognized over 365 days, right? In night and nickel, it is even sharper, the decline. Good news is that stuff is bouncing back. So quarter two has been better. We haven't announced the numbers yet, but there's been a reasonable sort of pickup, which leads us to believe that we were impacted more by lockdown than by COVID. Moment lockdown is over. Now, the Zomato, on the other hand, for example, in restaurant dining is kind of shut. Even though restaurants are open, there are not enough people going. So restaurants won't have money. They will not spend on advertising. So that part of the business is in the basement. But food delivery is bouncing back very nicely. And Zomato is now working at unit economics that are far, far superior to what they were pre-COVID and very close to breakeven. This also been able to access capital, which was not so easily available to Zomato maybe 6-9 months before, and now suddenly people are lining up outside to their door to put in money, right? So it's a sea change, right? You take a look at Shop Kirana. Shop Kirana delivers last mile dry groceries to the small Kirana store with the same day or 24-hour notice, right? Supposed to be essential, but first 15-20 days, the people are not allowed to go out and deliver.
Yeah.
But post that, it just took off, and now it's above pre-COVID levels. A company called Shoe Connect, which is now called Business, which is B2B supply chain in the footwear industry, the small manufacturer connected with a small retailer around the country. Because the offline supply chain was disrupted, it has actually benefited. So footwear is not essential. So April, May, shut down, but June it opened up, and now it is doing really well. A gramophone, where you guys have also invested, we are also there. It's still not back to pre-COVID levels, but margins are better than earlier. And it's focusing on a smaller tighter geography.
Yeah.
So they've had to sort of adjust their thing. Now, equally importantly, several of our companies have been able to access capital during the lockdown, during the, while COVID is still there. So Zomato access capital. Policybazaar, if it wants to, can get capital, but it doesn't need to. They'll decide. Gramophone, has got enough capital, and it may get in the future, but there is enough interest there. Ustra raised capital. So it's actually quite remarkable that investors are showing confidence as long as the business fundamentals are good, even during COVID.
Yeah.
Now, at some point in time, COVID will get over, but will it get over one day? Or it'll just sort of taper down? Or it'll come back, and then finally taper down? We don't know, and we don't know how long it'll take. But I think people are getting sort of learning to live with it. They're adjusting to it, and life is going on.
Yeah.
But yes, some business models will have more relevance. Food delivery, for example, will have more relevance, and simply because in restaurant dining is shut, more or less. Okay, home delivery of stuff will be perhaps more popular than it was earlier. Right. So there's a definite imperative for tech-enabled businesses.
Things have come up and things have gone down.
Yeah.
So one of the things which, for example, when I look at Asha Impact, or I look at some of the other so-called impact investors.
By the way, one little add-on. So Jeevan Sathi actually grew in the lockdown. So it looks like people were sitting at home and surfing and looking for life partners.
And so it grew in terms of you were able to make matches on Zoom, or like what is the
we don't know about that, but at least people spending time. People sitting at home in front of the laptops and the mobiles, and they were investing time in this activity. And in the process, some of them were paying us.
Okay, got it. And then did they actually meet, and was there social distancing, or how did that work?
No, we have not investigated.
Anyway, so a lot of the impact investors have one way of looking at it, and I'm talking about market-based returns, not sacrificing returns, etc. Is that they first look at an impact lens, like whatever the impact criteria is, does this company fit? Like I'll tell you with Asha Impact, the two ones that we've done together with you, Sanjeev, and we've done a couple with Padmini's office as well. Is that the first lens is the impact, and in our way we define impact as is the customer base at a certain income level where the product and service is not there. So it's obviously a fabulous business opportunity, but is the target market, like, we looked at some affordable housing, some mortgage companies, NBFCs targeted towards the bottom of the pyramid, etc. So there's first that impact lens. And then once it crosses that impact lens, then that's all good. Then you really kind of deep dive into the financial aspects of it to kind of underwrite it and see whether it makes sense or not. But then going forward, after you've made the investment, you have, at least from the way we think about it, we have financial KPIs and targets, but then we also have impact KPIs and make sure that the social entrepreneurs, et cetera, are kind of focused on that, because you also have enough examples of, companies that are impact oriented and then kind of mission drift because there's more profit to be made at wealthier customer bases, et cetera. And I know both of you don't really think of impact as the primary kind of lens. But how should impact investors or how should other investors think about this? I mean, have you morphed your thinking over a period of time? I know it's like you said, impact will just come and because scale is critical. But how, it's like if you don't measure it and hold management accountable for it, how do you actually make it happen? Sanjeev, do you want to start with that, and then maybe we'll go to Padmini?
Okay. So look, we are investing shareholder money.
Yeah.
It will be irresponsible on our part to go for anything other than superior financial return.
Correct.
At a lower risk. At the same time, naturally, the businesses have to be well run, well governed, doing the right thing, following the laws, right? Because in the long run, shareholder value cannot be created, by businesses which are not doing those things, right? Now, having said that, look, it feels great when businesses make impact, right? Because you've done the right thing, you've done well, and you've done good, right? And the truth is, if you do good but don't do well, when I say well, I mean financially well, you simply cannot scale and make impact at a scale where is required in a country.
I totally agree with that. So I'm actually talking about market-based returns. I mean, the one companies we've invested with you, we're not looking for subsidized returns. We're looking at market returns, but then we're also measuring the impact piece a little more proactively than probably you are. So the question is, should one do that or should one not?
Well, look, it's something, honestly, I've not applied my mind to yet. But now that you have mentioned it, maybe it's a good idea for impact investors to invest alongside, people who want a commercial return. So, they can benefit from both prisms. We can benefit from your lens.
Yeah.
And you can share us the data on impact.
See, that's exactly the fundamental thing which you said, that like impact investors alongside commercial investors, so that for market returns, is exactly the actual irony of the situation, because 75% of impact investors will say our target is to generate alpha and beat market-based returns, exactly what your target is. But in addition to measuring financial metrics, we are going to hold managements accountable for social metrics as well. So the question is that's the real issue in a way, that the mindset of being impact investors is that there's, you are kind of sacrificing return. Anyway, maybe it's a conversation you and I and other family offices should have, but that's exactly why I want to bring it up, because this is
ultimately, Vikram, I think you'll have to give something more priority than the other in the entrepreneur's head.
Yeah.
It's kind of hard to ride two horses equally well at the same time.
Well, let me tell you, so this is what we teach at, I'm going to bring Padmini in a second. So this is our course at Harvard Business School. So why can you not ride these two horses together? Because if you look at all the businesses you've invested in, Asha Impact is invested in, a lot of other kind of market-based investors, is that impact is inbuilt into the business model. They're not two separate issues. And so the more successful you are financially, the more impact you have. And the more impact you have, the more customers you get, the most financial success.
Yeah, that's great. But let me give you an example from our experience. I'm sorry, Padmini, you want to go first?
No, go. Doesn't matter. I can hold.
So, देखो, हमने Naukri.com चालू की थी in 1997.
Yeah.
Right? I started it.
Yeah.
Right? At that time, like a good MBA, I wrote down a vision statement. Okay? Somewhere along the way, that vision statement has got lost. And only 3 or 4 people remember it also, because there were only 3 or 4 people around that time. Now, that vision statement was to create a platform where every Indian who's looking for a job can find one. Okay? Now, that's a noble vision statement which creates impact.
Correct.
But the truth is, as the company grew, we raised venture capital, we went public, and the primary thing was, okay, we got to make profit. Now, there were obviously Now, what happened was the blue-collar worker, therefore, got left out, because it's hard to monetize that market. Right? Now about 8, 10, 12 people have tried to do blue-collar sites, blue-collar apps, employment apps. The truth is, nobody has really been able to solve this problem and scale and make a profit and make an impact. Yeah. Nobody yet. Right?
Very good. It's a very good example.
However, we have now focused our efforts. We have a separate team working on a blue-collar initiative called Job Hai. It's a part of our company. It's 100% owned by us, right? We believe that we have the insight, the knowledge, the capability technically, the capability product-wise, and the financial resources that if somebody can make a go of it, we can.
Yeah.
Once again, we are not doing it with the primary objective of making impact.
Totally.
But now with the surpluses the company is making, we are prepared to be a lot more patient and wait for profit. So we know first 5-7 years there won't be profit, right? But first you have to make the marketplace.
There are lots of unicorns that have no profit first 5-7 years. No?
Yeah, that's not the way. That's not the way we operate, unfortunately. Yeah, but we're prepared to wait. But we're saying we have to make the marketplace happen. We have to actually create value for the job seekers and the employers. So here's a little secret here. Naukri has got 90,000 clients. 90,000. There's a companies trying to hire people, right? Mm-hmm. Of those 90,000 clients, the top 10% give us 60% of our revenue. The top 20% give us 85%. So our profits really come from that segment. And therefore, a lot of our efforts thus far have been focused on satisfying those clients. Because they give us most of our profit.
Of course. Yeah.
In blue collar, you are not going to have that kind of head. Right? So hiring is ultra local, it is local language, it is very often audio and video, not a text resume. It is all those things. And a small enterprise is going to hire maybe 20 people in a year. Right? And they won't give you that kind of money. So how on earth can you make money in this market? But maybe there are a few million enterprises like that.
Yeah.
So it's a large, highly fragmented market. How do you make money?
Got it.
So we don't know how we can make money, but we know how to make the market happen, we believe.
Yeah, I understand. I mean, and again, we have a limited
but
time.
But if Naukri had not made the kind of money it has and it does, we perhaps would not have had either the knowledge or the financial ability to devote resources to this enterprise. But if blue collar succeeds, whether we make it work or somebody else makes it work, it can make a huge impact.
Correct. It make a huge impact, but there's also an opportunity in those kind of areas where it's not slam dunk in terms of what the profit model is bring in blended finance kind of opportunities where you actually bring in public and private capital, because blue collar job creation is one of the government's highest priorities. So is there a way to kind of marry the two? But Padmini, let me bring you in. What is your perspective on this?
My head is now swimming with lots of things that have been discussed. I'm going to make 2 comments and then we can go deeper, whichever one you want. Firstly, I think that in my DNA, I've just always seen social impact as a starting point. So I still find it tough to understand how businesses are sort of so separate from them. And it's just not 2 things, right? Today, if you look at Ambuja's story, right, as a company, so much of their decision making and their success came from doing things which had tremendous social impact, right? Whether it was the way they chose their dealer network, the way they focused on environment, the way they've created a product really for a retail customer and not for those big institutional buyers who were dominating the cement market at that point. So there was a lot of play on the social impact side of India, right? And from that point, I'm just saying, so firstly, the point I want to make is that I think social impact is a general choice that businesses can make, and it's a choice which large businesses can make and small businesses can make, and it's a choice they make, right? It's like where they go in saying, I'm going to have that thought process in what I do. And today we have companies which are listed companies which still operate in a space which is having impact with the poorest people in the country, but providing a product, which actually brings me to the second point of, what Sanjeev just brought up. I really think that the question we have to ask ourselves is that there is an established now understanding of the next billion, right, in the world, right? This group which is at this edge of, where they want to
aspiring
demand
middle class.
products. So they want to demand products and services, but they're at an edge where they've just come out of, not at the risk of poverty, but can easily lose their job, but they're there, but they want products and they want services and they want quality and they want it at a price point and they want it delivered in their homes in whatever way, to their families. right? So that could be whether it's, low cost education options or others, but they still want quality, right? So when businesses also, like, for example, and I'm saying this, that I don't know the blue collar example from the way Sanjeev is thinking, but I'll give it to you from a different lens. We've done a number of studies, these skill and entrepreneur development institutes across the country, which are basically for those who dropped out of education and are now taking skills and getting back into mainstream industry. We've actually challenged ourselves to say that, we will not go out of pocket on that. We need to make sure that the money for that course is paid by either the beneficiary or the person hiring, and that we will ensure to try to 100% hiring into the industry. So the point I'm trying to just make is that if there is value, then even that person, whether it's the next billion or it's the person from a village in India, will pay a price for that service. That service is of value to that person. Sometimes we got to go and ask ourselves these questions to say, also what is happening is we're becoming lazy. When we don't do well at something, we put it in social impact or we put it in philanthropy and we let it be and say, it's okay. We didn't make business, but we had social impact. I'm thinking that's not a fair thing to, just...
It's like a cop-out, a complete cop-out.
Yeah. They were taking the easy option. That's not true, right? We've demonstrated that, people are willing to go in to do institutional deliveries in hospitals at low-cost models for institutional delivery. And there is a whole chain of hospitals getting created around, that kind of thing. So there was somebody as a customer, right, who went and paid whatever that amount of money is to go and get that delivery done in an institution, right? So if in the healthcare, there are those models, same for schools, right? There are those models, same for skilling. Now the models are appearing, right? So I'm saying, let's challenge that. Let's challenge that and say, I want to have social impact and I want to deliver to that segment and I still want to make money. I don't want
to... That's exactly right. And it's hard to do, Padmini. That's exactly your point, which is that a lot of time people say, oh, impact investing is just another excuse for bad investing. You do make something and then you don't want to focus, or then it's philanthropy. Yeah, I didn't generate my return that I was looking over, but I did some good at the same time. And that mindset has to change. Now, there is a whole chunk, you can make the argument like what Sanjeev's model, which is, and may not be for InfoEdge, but it may be that for blue collar workers, the business model will not generate a cost of capital. And there's a whole chunk of impact investors which are consciously, and a lot of it is family offices, a lot of it development financial institutions, consciously taking a financial hit for impact. But then you have to be very, very disciplined about, okay, if I'm going to take a 5 to 10% hit on my financial return, I need to compensate myself for getting that much more social impact. And how am I actually going to go about doing it? One question which has come up in the chat is that we're talking about equity, and maybe Padmini, you can talk a little bit about this. What about other forms of capital to kind of move, like debt, blended capital? What are your thoughts on that, and how should a family office look at that?
Yeah, I think this is a perfect point to segue into this, because also I wanted to, put on the table this point that sometimes I think that we also do a disservice when we encourage our investee companies to only consider equity. The problem then comes is that sometimes when you know that the model is not going to be able to generate those kind of returns that equity investors expect, we should actually start looking at other models, like looking at, impact bonds and things like that. And, there are interesting models that are being developed, right? Even Asha Impact is trying to develop such interesting ideas. We should definitely dissuade them from then going the equity route, which then, it's like it takes you into this abyss of not delivering on equity and then making the whole sector look like, oh, but this sector never delivers on equity. I think we sometimes should think about matching the right instrument. And in the case where the idea seems a little more on the philanthropic side, but not as a sustainable investment side, then looking at an impact bond idea or something in those kind of models start resonating better for investors, because then they know exactly where they want to place their money and why they're doing it, right? It's sort of defining it. But I think also it's important for us to guide investee companies to be open to doing it. Everyone wants to be in equity, but I think that that's a big disservice we do by allowing that to always happen. And then
we should be more flexible in different parts of capital structure. I mean, Omidyar network, and again, we teach this in my class, they've got a very good kind of, I think, a good framework on, you have the A investments, which are market-based. There's an impact aspect. A lot of those investments are co-investments with the InfoEdges and the Sequoias of the world. And then you have a middle bucket, which is, yes, this customer base cannot generate the capital or return that's needed. So we need different kind of structures, or we're creating a new kind of market, which has not been proven. And by definition, it's going to be longer time horizon with more risk. We're willing to do it. And the third bucket is philanthropy. I want to ask you, because we only have 5 or 10 minutes left, Sanjeev, maybe to you, as an investor, because a lot of people are on this session, who are entrepreneurs, who may be looking for capital, looking to grow their businesses. As one of the most successful investors, venture capital investors out there from India, what would be your 3 or 4 key pieces of advice to a potential, to social entrepreneurs, or to entrepreneurs rather, going forward?
So I'll give it to entrepreneurs. I don't divide entrepreneurs into buckets.
There's no difference. That's why I corrected myself.
Yeah. So look, a couple of things I do say to people who come to me for advice, early stage people, we go in early. I say, look, the customer's money is more important than the investor's money, right? Because if you're getting the customer's money and you're getting it repeatedly and you're getting it at a price that's higher than the cost, which in today's jargon is called good unit economics, right? Then chances are that you have a viable business so long as you get enough customers, right? And if you get the customer's money on these terms, then the investor's money will almost certainly follow. Because investors love to invest behind businesses that are getting customer money, right? On the other hand, if you get investors' money first, it does not necessarily mean that the customer's money will follow. Because the customer is not, customer not be impressed by your PowerPoint. Your product has to deliver, right? And that's when the customer gives you money. Customer is not your mother or your father or your uncle or your aunt who will repeatedly give you money, because he knows you.
Not a charitable organization.
Yeah. Yeah. Okay. So that's the first thing I say, right? The second thing that we look for when somebody comes to us, we look for evidence of natural attraction, right? So what I say is that, look, successful businesses are built on deep customer insights, right? So when I met Dipinder Goyal for the first time, he was running a small site called Foodie Bay, which, had about 800 restaurants from Delhi NCR listed on it, and I think Bombay, Bangalore also had some restaurants, and he was doing 1 lakh revenue a month, right? And I asked him, "Ye idea kahan se aaya? Where did you get this idea from?" And he said, "Look, I was working." So Dipinder was 28 then, right? This is 2010 I met him, right? He finished from IIT in 2005, tried to do a startup for a year, didn't work. 2006 he joined Bain Consulting, right? And he said, "Look, Bain Consulting is an office in Gurgaon where maybe 50, 60, 70 people work, mostly young, mostly males, mostly living away from home, would not get food from home, working long hours. You had to have lunch and frequently dinner also in office. Often at a cafeteria, but they would not serve food. You could bring your own food and eat it there." So to make life easy for the employees of Bain, the admin guys had collated a file folder of roughly 80 restaurants, delivery menu cards, which would deliver to that venue. So you could choose your food to the restaurant and then call up and order. And he said, at 1 p.m. there would be a massive long line to access that file folder. And it took me 20 minutes. I would get waiting for the folder. Then I quickly decide in 2 minutes. Then I call up, and then somebody else takes the folder. It's a pain. So I came in one Saturday, and I scanned all those cards, and I uploaded them on my personal page on the office intranet. Right? He says, within 2 days, the IT infra guy came to me and said, "What have you done? Why is all the internal traffic 95% going to your page?" Okay, and he said, that's when the penny dropped. And I said, hey, it's not just my problem alone. Everybody wants to see the menu cards. So he had a customer insight that aggregation of menu cards is what value. And that's what he did. He was not the first restaurant listing site, but he was the first restaurant listing site that aggregated all the menu cards. Yeah. Right? And I used to do the site. I liked it. Hitesh liked it. And that's how we reached out to him. It was a cold call. He didn't come and pitch to us. Investors saw the so deep customer insight, everyone's natural reaction. So these are a couple of things we look for. But the third thing I say is it's always better to raise money when the investor comes to you rather than you having to go and pitch. It means that you have checked some boxes for the investor without even knowing it. You're getting customer money, you're getting natural traction, your business is based on insight, it's growing anyway, people have found you. Now, if the investor comes to you rather than you going to the investor, chances are you'll get the valuation you want, you'll get the money you want, you'll get the terms you want.
Great. Excellent.
Right? I'll say many other things, but I'll stop here.
That's great. Thank you, Sanjeev. One of the key things, and we're going to conclude here pretty soon, but one of the key things which we've seen a trend is this whole area of, I'm not getting back to the family office, is this, we did a study which, interviewed baby boomers, next, Gen Z, millennials, Gen X, and is impact important to you in your investment portfolio, et cetera. And, maybe about 20-25% of baby boomers, which is like Sanjeev and I basically said, yeah, it's kind of interesting, but, on the millennial and the Gen Z side, it was more like 70 to 80%. And what we're finding in a lot of family offices where the younger generation, the older generation have this thing, okay, I'm going to make money, how I make it, et cetera, is kind of not relevant. I mean, obviously I'm not going to do unethical things, but I'm not focused on the impact aspect. And then I'll give away 5% in charity, every year or whatever. While the millennials have been saying, no, well, we should really incorporate impact, not to sacrifice return, into our investment portfolio, because why are these two things separate? They shouldn't be separate. So Padmini, I'll give you the last word before we close. What is your advice to family offices out there? We have a lot of them on the call here, as to how they should be thinking about these issues.
So I actually do think that, the entire segment, the whole space has really evolved tremendously in the last 15 years that we've really been looking at it. And I think that it's becoming very, very exciting. I think that, when you look at internet penetration in India, and I'm sort of segueing a little bit away from what you've said, but, when you look at internet penetration in India and you see that the internet users in India, more than 56%, I'm told, are doing it not in English, in languages. Right? Who are these users? Where are they? What are they asking? What are they looking for? This is that target, right? The whole growth of India is the Bharat that we're talking about. That's really exciting. And so much is going to happen now in the sectors around this target group. I feel that it's a huge opportunity for all investors to really participate and be part of the returns that are going to come out of these that this impact. But I wanted to add to a point that you made on this millennial and, the younger generation wanting to really they're far, more socially conscious maybe.
Are you a millennial? I think you're millennial. We'll put you in millennial category.
I'm not millennial, but my daughter is. Thank you for that. Thank you for that compliment. But I just wanted to say that, there's one more thing I want to sort of say, which I feel very proud of. I feel that in India, we underestimate our DNA of wanting to do good. We do good as part of our culture so easily that I think that we can really make a huge difference as a country in terms of, even philanthropic giving, though big giving in India has not been there as, and like in how you see it in America, for example, where you really see that big giving. But I call that sort of more flashy giving. But here, every day, in all homes, you'll see some sense of giving. Right? Having on small occasions and whatever, religious occasions, whatever, the big, deep need to give. So I feel we're already a society so poised in that ability to understand and empathize and do good for our own country. And we're at that inflection point, of really seeing growth happen. We're seeing now, as I said, agri is such a big space that for us, we're so excited with last mile. Invest in a last mile delivery company, which is also looking at warehousing and connecting farmers last mile. And we just think so much done, so many efficiencies to be really, encashed from and all of that, which will play out and across all the sectors we've seen. So I think to your question, my advice is just to look out for great opportunities that are coming and go in, just as long as you have strong execution. Please see the leadership quality and the talent quality coming into these impact businesses. These leaders are no more like people who are from some rural area only or something. They're IIT and MBAs and top quality individuals. Right today, the investment, they're all led by people from LBS and IIT and whatever else. And properly well-educated, well thought through entrepreneurs coming into these businesses, building them at scale. really going and putting in their skin into the execution. I think, we're going to see those opportunities. I think we're very excited to really see. We have to move our numbers. So we're going to
this is the most upbeat way we could possibly complete this panel. So we've run out of time. So thank you, Padmini, for that uplifting conclusion, and for Sanjeev for your very wonderful insights in terms of entrepreneurs and how to make good investments and scale and the importance of scalability. It's been absolutely fabulous for me to have this conversation with you, and I really appreciate, on behalf of IIC and everybody else, the fact that you took an hour away from your busy schedule to do this with us. So thank you so much.
Thank you so much for
having us. Thank you.
Thank you. Thank you, Sanjeev. Thank you, Sanjeev. Thank you, Padmini and Vikram. I think outstanding moderation as always. And I think it was a great session. I think we got to hear very, very different perspectives, but I think there was a certain commonality in terms of the way, people thought about, the whole combination of impact and generation of, quality returns. With this, we come to the end of today's session. I think it's been a great day today. We had a panel on the global, impact investing space. We had a second panel which spoke about the Indian impact investing story, what's been the journey over the last 20 years. And I think we had a fantastic end with really looking at how HNIs and family offices look at this entire space of early stage VC investing and impact, investing in that perspective. We've had more than 350 to 400 people present here. Through the sessions from across the world. We had, I think, people from 17, 18 countries today, other than obviously people from India. Tomorrow promises to be even better. We start at 5, and we have a keynote from Sri Kaji, Deputy Managing Director, NABARD, arguably India's largest impact investor in the agri sector. We also have tomorrow, our special for tomorrow is the Agriculture Roundtable. We have 7, 8 key investors and entrepreneurs in the agriculture space where we are joining to discuss the increasing interest and excitement about the agri space. We also have a very important policy panel, really looking at what is it that we can advocate with the government and how can we really get the government onto our side to support impact investing. And lastly, just like today we had LPs and family offices domestically, we have a session with LPs and family offices international, and they talking about how do they look at impact investing across emerging markets, how do they compare India with other emerging markets, and so on and so forth. So tomorrow promises to be as exciting and as interesting as today. And thank you all. We would like to see you again, and we hope to see you again tomorrow at 5. With this, we come to an end. Thank you again, Sanjeev. Thank you, Padmini and Vikram, for this session. Good evening and good night to everyone. Thanks a lot. Bye-bye.
Thank you. Bye-bye.
Bye-bye. Bye-bye.